right, good morning, everyone. Trust you are well and good this morning. It's good to have you join us today. We are glad you could all join us today. It's my pleasure to welcome you to today's webinar session. I am Patience Aliu, a manager in the Regulatory and Dispute Resolution Services team of Andersen in Nigeria, and I will be the moderator for today's webinar. Please, would like to apologize for the late start. We were, waiting to have a full house, but now we do. So thank you again for joining us. So today we will be discussing the proposed tax reforms and understanding the key changes and their implications for stakeholders. As we may all be aware, the tax reform bills being discussed are the Nigerian Tax Bill, the Nigerian Tax Administration Bill, the Joint Revenue Board Establishment Bill, and the Nigerian Revenue Service Establishment Bill. These bills seek to introduce major changes to the Nigerian tax system, which include amendments to the rates of the company's income tax, personal income tax, the introduction of global minimum tax to multinational companies, amongst other amendments to tax administration in Nigeria. Recently, these bills were approved by and passed by the House of Representatives. We still await the concurrence of the Senate and the presidential assent for the bills to become law. Today, I am joined by an array of seasoned professionals who are renowned experts in their fields, and they will share their insights and expertise on this important topic. A special thanks again to our panelists for joining us, and a special thanks to you, our audience, as well for joining us today. Please note that if you have any questions during the course of today's session, you can drop them in the comment section at any time, and we will take them as time permits. All right, so before delving into the main discussions of the day and the panel session, I will yield the floor to Olaleye Adebiyi, the managing partner of Andersen in Nigeria and co-regional partner for Africa, for some opening remarks. Welcome, Leye. You have the floor.
Thank you, everyone. Good morning. Thank you to the panelists who accepted our invitation to participate in this webinar. So I welcome you all to this Andersen webinar titled Proposed Tax Reforms, Understanding the Key Changes and the Application for Stakeholders. There is no better time to discuss this topic than now, when stakeholder views are still being accepted, and no better person to lead that discussion other than the chief architect leading the reform, Mr. Taiwo Oyedele, Chairman, Presidential Fiscal Policy and Tax Reform Committee. Thanks, Taiwo. Looking back through history, it is the first time after independence that the country is doing a major overhaul of the taxation system. Nigeria had always intended to improve its tax to GDP ratio without taking the necessary step of widening the tax net. For the first time, that correction is being made. The tax net is widening. So we need to commend all those behind these initiatives. Sorry. The webinar is supposed to educate stakeholders about the far-reaching changes in the tax bill and also elicit reactions on what could be done better. It is unlikely that we'll get everything right this first time. For me, it is an excellent start, and we can refine the product through amendment as we go along. For example, an article published in Business Day by Andersen yesterday highlighted some areas that need to be looked into. That's the discretionary part of the National Revenue Service. Tax needs certainty to enable planning. So I welcome the panelists and also participants who have any question to ask me. This is supposed to discuss a law that will affect us all. So I believe everyone listening is looking forward to a better and more prosperous Nigeria, where 800,000 naira currently exempted from tax in the tax bill will be liable to pay tax. So it's a good start, like I said. Welcome the panelists and thank you for everyone who are leading this session. Welcome to the Andersen panel. Thank you.
Thank you, Leye, again for those insightful remarks. Without further ado, we will dive straight into the business of the day. But first, I would like to introduce our guest speaker to give us the background to the tax reform bills and set the tone for today's discussion. Our guest speaker is Mr. Taiwo Oyedele. Mr. Taiwo Oyedele is the chairman of the Presidential Committee on Fiscal Policy and Tax Reforms set up by the President, with a broad mandate to carry out critical reforms bordering on fiscal governance, revenue transformation, and economic growth facilitation. And this presidential committee is the brain behind the tax reform bills. Prior to his current role, Mr. Oyedele was the fiscal policy partner and Africa tax leader at PwC. He was the thematic lead for the Fiscal Policy and Planning Commission and chairman of the West Africa Debt Management Roundtable of the Nigerian Economic Summit Group, chairman of the Taxation and Fiscal Policy Faculty Board of the Institute of Chartered Accountants of Nigeria, a member of the Nigerian Taxation Standards Board of the CITN, and a member of the Ministerial Committee on the Design and Implementation of Nigeria's National Tax Policy. Mr. Oyedele is an accountant and an economist by training. He is an author, keynote speaker, mentor, and commentator on finance, business, and economic matters. With a warm welcome and virtual round of applause, let us welcome Mr. Oyedele. Over to you, Mr. Oyedele.
Good morning, and thank you for the introduction, and thank you to Andersen for inviting me. And also a very good morning to my brother, Mr. Olaleye Adebiyi, and to the other partners from Andersen, and also a warm welcome to all the participants on this webinar. I think what I want to speak to is first, broadly, why are we reforming? And then two, what are those areas where people need to pay more attention to without going into too much details? Because I know that in an event like this, time is never our friend. And then what should the next steps be? So I'll start with the need for the reform. And for those who have been following this very important reform, you would have observed that Mr. President has been insistent on the fact that he does not want to negotiate the need for the reform. And that's understandable, and we agree with Mr. President. We think that what should be up for discussion is the contents and the details of those reforms. By the way, the reforms are much bigger than the tax bills. The tax reform bills are just one component of the fiscal policy and tax reform exercise that is going on. I do acknowledge and recognize that matters to do with taxation affect people directly, and therefore they're quite sensitive to it. And hence, especially because also due to the controversy that was generated, very many Nigerians believe that all that our committee has been doing and is meant to do is just the tax reform bill. So that would not be exactly correct. So the broad mandate of the committee include fiscal governance, which is to do with how Nigeria manages her finances, including revenue from taxes, revenue from other sources, how we spend our money, including the structure of the budget, the priority of spending, the quality of spending. And then, of course, when the revenue we generate is not enough, how do we borrow? Issues around our borrowing and debt management framework. In addition to that, that fiscal governance also covers the interaction of policies and how consistent they are, both within the federal government level and across subnational, particularly when it comes to fiscal, monetary, and trade policies. And also included in fiscal governance is the fiscal thresholds and limits. What should be our debt to GDP ratio? What should be the budget deficit to GDP ratio? What should be debt service to revenue? All those important benchmarks. What are they currently? Are they ideal? Should they be something else, and why? And once those limits have been set, how do we ensure that they are respected? And when they are not respected, the consequences for not respecting those thresholds. Because some of the challenges that we are facing today can be attributed to the excessive use of weights and means by the previous administration, where over 30 trillion naira was printed. And there's no way you do that and there won't be consequences for the economy. Unfortunately, those consequences will not happen immediately. They take time. And for many of our citizens, they will not be able to make the connection between when they are dealing with the consequences and when the violations took place. Based on the laws today, as a country, we should not have borrowed more than 5% of the previous year's revenue. We did not do 10, we did not do 15, we did hundreds of percentages. Clearly not ideal. So the second broad mandate that we have is revenue transformation. It's under this component that you have tax bills and tax reform. Beyond taxes, we also are looking at other revenues, including revenue from government-owned enterprises, such as NNPC. We're looking at revenue from government assets, including real estate. If you think about NIPOs and the real property they have across the country, even think about the sports commission, stadia, what do you do with them? How do you transform these assets to revenue generating productive activities that will not only generate revenue for the government, but will create economic activities that will then stimulate employment and growth on a sustainable basis. We're also focusing on natural resources, including oil and gas and solid minerals. So the last part of our work is economic growth and competitiveness. And this is based on the realization that in the long term, the way to generate revenue is to have an economy that is growing, is to have an economy that is competitive, is to have businesses that are doing well, is to have individuals that are thriving, so that out of their successes and prosperity, they can then pay a percentage or a share of that to the government by way of taxes. So under that pillar of our work, we're looking at impediments and bottlenecks to trade, whether you're an exporter, whether you're a large business, whether you're a domestic company, whether you're a multinational, whether you're a fixed income investor, whether you're investing in the real sector, whatever it is. Are there fiscal impediments first and foremost that we can get rid of? And in addition to that, are there other impediments that may not be fiscal, but which we can then identify and direct to the appropriate quarters for them to address? For example, many of our stakeholders that we engage with, give us feedback about overregulation, right? Which is just as bad or maybe even worse than overtaxation. We have excessive tax burden. And some of these taxes are collected by non-state actors, which means that the chances of getting fiscal exchange in terms of value for taxes you pay is zero. Because if the money hasn't gone to the government officially, the chances that they'll build roads, that they'll provide hospitals and build schools is non-existent. So we have to address all those issues. These are some of the reasons why the people are paying so much, but government is collecting so little. Especially when you add to the fact that even when the taxes are legitimate, they are sometimes collected illegitimately, and sometimes we have significant leakages and corruption that depletes those revenue from getting into government, and consequently being able to utilize it for the benefits of the people. So if we now, zoom in on the tax reform aspect, I'm sure almost everybody on the call will already be familiar with the 4 tax bills, so I won't go into the details. But I only just want to encourage particularly tax professionals, taxpayers, and public analysts to pay attention to other areas of the bills, because the issue that the governors raised, starting with the northern governors and then by extension to the NEC, and then subsequently the engagement we had with the Governors Forum and their counter offers, a lot of people would think that the tax reform bills are just about sharing VAT revenue, wanting to raise VAT rates, and inheritance tax. You can actually count the issues that people have been debating on your fingertips. Whereas these are reforms that are around 400 pages with more than 200 very important reforms that cut across. Whether you're talking about the tax officers, the tax administration system, the harmonization of the revenue administration, the use of technology, how do you ensure data integrity? How do we use artificial intelligence? How do we ensure that we curb corruption? How do we improve the governance of the revenue administration in Nigeria? How do we ensure there's coordination, not only in terms of how we govern ourselves and administer tax revenues, but also in terms of the tax identification that you have for your taxpayers? Why is it that as Taiwo Yedele, I have more than one tax ID within the Nigerian tax system? I'm resident in Lagos State, so I have a tax ID from the LRS. I also have another tax ID from the Joint Tax Board. I have a business that has another ID from the FRS. So that's making it difficult, if not impossible, for the government to piece information together and know who I am within the system. And that means I can game the system to the disadvantage of the system. But it also means that if I want to do something in Ekiti, for example, maybe I want to buy a plot of land, they're likely to insist that I have to pay taxes there because, one, they don't trust whether I've paid taxes anywhere, and maybe they actually don't care whether I have paid elsewhere, contrary to what the law says. So we need to address these issues. There's some of the reforms that are impacting or going to impact on tax agents. These are intermediaries, consultants, professionals who represent taxpayers. For as long as we have known the tax system in Nigeria, we haven't had a framework that ensures that those professionals behave professionally, that they are technically competent, and that they embrace highest level of ethical standards. Without this component, the system cannot work. And when the tax professional does not know what they are doing because they are not technically competent, or when they are not ethically inclined and they do not see anything wrong with deliberately under declaring income, hiding them, making fake receipts, or paying a bribe to settle tax disputes, they act as if they are a virus, because now they're not dealing with their own tax affairs alone. They're helping other people do those wrong things. So, you know, viruses spread so quickly. If you don't deal with it, the system will collapse. So we have also introduced, therefore, a framework to regulate tax professionals. And I know many of our stakeholders are pushing back, but we keep saying to ourselves, these reforms are not about anyone. These reforms are about our country. When you have a Nigeria that works, everyone will find a space for it within a Nigeria that works. It's like a rising tide lifts all boats. I can tell you in all sincerity that even as the chairman of the committee, many of the reforms are affecting me personally, including my family affairs and whatever I've set up for my retirement is being significantly impacted. But I cannot, in good conscience, because I have the opportunity to share the committee and say, let's not do this one because I think it would affect me. I'll be failing myself and be failing my country. So everyone, almost everyone, agrees that there's a need for reform, but most people say, you can move things around, but just leave me alone. I say, how does it work? That you do reforms and then you leave some people alone without, you know, ensuring that we have some movement here and there. So, in addition to, you know, tax agents, we also have provisions that are going to significantly affect the taxpayers, the businesses, whether they are large, whether they're small, whether they are medium, whether they are multinational, whether they are even government agencies. local corporation, group arrangement, reorganization, investment abroad, issues to do with unilateral tax credit to ensure that there's no double taxation that is not intended. We have all of those things covered. We have those that will help us to ensure economic stability and then growth, like being able to pay your taxes in Naira. Why is it that we're asking Nigerian businesses to pay certain taxes in foreign currency? Why? So I have to go and look for the dollars to pay Zoom for the Zoom application. And then there is withholding tax or VAT on it. I have to go and look for dollars to pay the Nigerian government. It doesn't make sense. It doesn't add to the dollar liquidity in Nigeria, but it does add to the pressure on the Naira, making it depreciate even further. And once Naira depreciates, there is a pass-through effect into inflation. And when there's inflation, all of us suffer. In fact, inflation can be described as the way that government collects taxes from the people without legislation. So inflation is taxation without legislation. And unfortunately, that taxation unduly and disproportionately affect the people at the lower end of the ladder than the middle class and the upper class, and that is not fair. So I'll stop here, but I'll say in terms of the next steps, I would encourage anyone who is a taxpayer, anyone who is a tax professional, anyone who is a tax officer, anyone who is a public analyst. So I'm calling out those people specifically to spend time to read and understand. And if you go to our website, fiscalreforms.ng, and you go to our social media accounts, we have LinkedIn, we have Facebook, we have Twitter, we have Instagram, and we have YouTube. You will find a lot of information there. For those who are following me, if you just find any of my accounts, you would also find this information there. What we have done is to try and simplify a lot of the summaries and the highlights in a way that ordinary people can relate to and connect with. That's a good starting point. But if you're in any of these 4 categories, you shouldn't stop there. You need to do more. So I'll stop there. Thank you for the opportunity, and look forward to the rest of the program. Thank you.
Administration system, and even the introduction of artificial intelligence, which we do not see much debate or conversation about in the public space. So please take note of that. As he has said, you can visit the fiscalreform.ng website or their social media platforms to have a more holistic view of what the tax reform bills are proposing. So we would move ahead. So what we have done in this session is that while participants were registering, we had solicited some questions from them, and interestingly, I think majority of the questions still revolve around the VAT and the same things that have been in the public space and under debate. But we'll still talk about them, and if there are other questions as well that are specific to certain industries, we will share that across the panelists to address the questions rather. All right, so now we will be moving quickly to the panel session. As I have mentioned earlier, today we are joined by an array of seasoned panelists who will share their expertise on today's discourse. And we had over 600 people register for this session, so we definitely expect a full house. So in no particular order, I will be introducing the panelists who will be joining Mr. Oyedele in facilitating today's discussion. First, we have Mr. Michael Ango. Mr. Ango is the acting executive chairman of the Federal Capital Territory Internal Revenue Service. He has over 20 years of service in various public and private sector capacities. He holds a Master of Laws degree from the Columbia University School of Law, New York, and a Bachelor of Laws degree from Ahmadu Bello University, Zaria. Prior to joining the FCT IRS, Mr. Ango was a partner at Andersen in Nigeria, where he headed the Tax Advisory and Regulatory Services units. He was also formerly the head of Public and Policy and Public Affairs at Guinness Nigeria PLC. Head of Legal and Stakeholder Relations at Nigeria Incentive-Based Risk Sharing System for Agricultural Lending, PLC. That's a Central Bank of Nigeria subsidiary. And he also served on the Presidential Committee on Fiscal Policy and Tax Reforms. He's also a member of the Chartered Institute of Taxation of Nigeria. So welcome with me, Mr. Michael Angle. We also have with us Mr. Ogaga Ologe. Mr. Ogaga is the Group Chief Financial Officer of the TGI Group. Prior to joining TGI, he was a finance director at Cadbury Nigeria PLC, where he was overseeing the finance function, supporting the growth strategy and operations, and ensuring full compliance of controls and procedures. He also provided strategic guidance and oversight on financial matters. As a certified accountant, his experience covers financial control, reporting, compliance, planning, analysis, and business partnering. And we have Mr. Ogaga here today to give us some perspectives from the industry. So please let us welcome Mr. Ogaga Ologe. Next, we have Oladipo Maye. Dipo Maye is the partner and head of the Oil, Gas, and Power Group at Andersen in Nigeria. He has over 21 years experience as an accountant and tax consultant. During this period, he has worked on various commercial tax advisory and compliance and financial accounting engagements. Today, Mr. Maye will bring his wealth of experience on board in sharing his thoughts on the proposed tax reforms in Nigeria. You are welcome, Mr. Dipo Maye. Last but not least, we have Chinedu Ezomike. Chinedu Ezomike is the partner and head of the commercial practice group at Andersen in Nigeria. He has over 20 years experience in the professional tax and regulatory services, which he provides to clients in various industries. His tax and regulatory experience covers corporate tax planning, tax due diligence, tax advisory, and compliance for local and multinational companies in various industries. He has led several advocacy efforts aimed at improving the tax environment in Nigeria and has also worked with several companies in resolving tax disputes with various tax authorities. He has been involved in capacity building for both client personnel and revenue officials and has written and published several tax-related articles both locally and internationally. Please let us welcome Mr. Chinedu Ezomike. A special welcome once again to all our panelists. I'm sure you are poised and set to share your knowledge on today's discourse. So for all participants and attendees, please remember you can still drop comments in the comment section, questions, and if time permits, we will get to them. However, we have questions for the panelists already and questions that were sent to us by people who had registered previously, so we'll take them in turns. So thank you to all our panelists for joining us today once again. I'll go straight to the questions. And as much as possible, we can keep our responses as succinct and as insightful as possible at the same time. The first question we have here is for Mr. Ogaga. And what the people would like to know is, from an industry perspective, what are your general thoughts about the tax reforms? Would you say they are welcome developments, or do you have some reservations?
Good morning. Good morning, everyone, and thanks, Andersen, for bringing me to this panelist. I also want to thank Mr. Taiwo Oyodele for actually shedding some good light on tax reforms that has been happening. Like he said, at least the payee one will affect me because certainly my tax will go up. So I'm not complaining about that, but I think it's the reality of life. So the tax reform bill, I think from an industry point of view, it's something that is welcomed because it will help promote uniform procedures for a consistent administration of tax laws, which will also facilitate tax compliance and by taxpayers. So it's fine. It's something that we look forward to because some of these things are actually giving better understanding to some of the taxes that we have. In terms of interpretation, implementation, there's always this gap between what I see what I implement, what I interpret versus what the taxman interprets. So it's a welcome development, but what we're looking forward to is that most of these things should be implemented right. And it's fine that there's some businesses that were not within the tax net. For instance, if you look at crypto space, you look at the industry within the social media space, these reforms are bringing them into the tax net, which will probably increase government revenue. And if that is spent right, it will actually help create a conducive environment for people to operate in. Because what businesses want is that they want an economy that is stable so that we can be able to at least get the good benefit of governance. So tax reform would help that. And one of the things that we've seen now is the Finance Act coming every year or every once in 2 years also helps with this interpretation and implementation of some of these laws. So from an industry point of view, it's a welcome development. And we have someone who is very versatile in the industry implementing this, and that is Mr. Taiwo Idele. So we are happy that he has that understanding and will probably also speak for some of these taxpayers. I don't think the issue is whether we're paying more or not. The fact is that if the laws are clear, then I'll be able to plan well. And I'll plan well in advance for some of these things that are happening. But if it is not so clear, it's now difficult for companies to plan some of these things. So from an industry point of view, I think it's a welcome development.
All right, thank you very much, Mr. Ogaga. From what I hear you say, you are all for increase in government revenue so long as it results in a stable economy.
Correct.
And the laws are clear and you are able to plan well. All right, so thank you very much for that contribution. There is another question here from you, and it's specific to a provision in the Nigerian Tax Administration Bill. It says, now this section 29 of this bill provides that any person who enters or intends to enter into any transaction or agreement, and that agreement, the principal purpose of that agreement is to enable them obtain a tax advantage. The bill says that such arrangements or transaction should be disclosed to the tax authorities. Now, we all know that companies engage in tax planning, particularly group companies, engage in legitimate tax planning and tax structuring. How do you think this provision that is saying that if we want to adopt certain tax planning strategies to our advantage, we should inform the tax authorities? How do you think this provision would discourage businesses from utilizing such structures? Do you think it can lead to litigation?
I'm not speaking on behalf of TGI. I think the definition of tax advantage needs to be very clear. And we all know the behavior of the tax authorities when it comes to tax liabilities. So if I'm going to send my tax planning or some of the things we are planning to do because tax planning is legal, it's not illegal. It's something that most organizations do advantage of the tax incentives within the confines of the law. So it boils down on trust. We all know the tax authority wants to impose more taxes on companies, and companies are also trying to reduce their tax liability. So if I have some tax planning initiatives that would help me manage the taxes within the group companies, and if I put that forward to the tax authorities, what do you think would happen? From where we sit now, I don't think we would find I think that would probably be a subject to an audit where I've implemented it and the guys would say, no, they don't agree. So it may lead, of course, to more litigation because people will have to go to arbitration to dispute whatever the tax man would bring to the table. So I think it boils down to trust. I don't think we're there yet. I hope we get there, whereby the tax authorities work hand in hand with companies to take advantage of tax incentives within the law. Because once you take advantage, because if I want to bring in a new product and I know that I could get pioneer status, and if I'm encouraged to go into that, I would go into it. But the situation whereby a taxman comes to your office to do an audit, and what you see there is ridiculous amount of liabilities imposed on you, and it takes months in and out, manpower has to resolve such disputes, I don't think I would want to share with them any plan, because I know that they would look for ways to find an interpretation that does not work in my favor. So I hope we get there with most of these reforms that are happening. But as for now, most companies would not want to share such initiatives with the tax authorities, because they know that the current behavior of the tax authorities is probably to see how they can increase the liabilities without finding out benefits that the companies would get in such arrangements.
All right, thank you very much for that response. What I hear you say is that let's function with trust, basically. We want to see a situation where the tax authorities are working hand in hand with taxpayers to take advantage of tax incentives that are legitimate and in the law, so that we can work together for a better and more stable economy. So thank you so much for your contributions. I would move around now, and the next question will be for Michael Ango. Yes. So, Mr. Ango, let's hear your thoughts on the proposed graduated personal income tax rates. That's the new graduated scale. What does the change that is being proposed under the Nigerian tax bill, what does it mean for both government revenue and the disposable income of the non-corporate taxpayer? So I want to hear your thoughts about it.
All right, thank you very much, Blessing, and good morning to everyone here, participants and panelists. Before I answer your question, let me just reiterate some of the things that Mr. Oyedele had said, with particular reference to the overall focus of the reforms. So you know, the reforms are not really targeted merely at improving government revenue or even the ability of revenue authorities to collect tax. I think there was a much more, you know, larger focus or broader focus, would I say, which was impacting the ability of the Nigerian economy to attract and retain investment, to create wealth, to create economic growth, sustainable economic growth. And like he rightly said, one of the things that determines the strength of an economy, of course, is the GDP of the economy, the spending power, the ability of citizens to be able to purchase what they need for their day-to-day livelihood. So that brings me then to the issue of the new tax table, as we call it, in the Nigerian administration bill. On a lighter note, maybe 7 or 8 months ago, I would have been much more in support of the graduated table and the exemption of income threshold to 800,000 naira. But sitting as where I am today, you know, for some of us, we are not really, you know, we look at the tax table with some trepidation. But on a more serious note, the reality of what the tax table has set out to achieve is to free up income. We know the realities of the Nigerian economy today, the inflation, and the fact that the minimum rate 70,000 naira. So if you calculate minimum wage at 70,000, it means then that the person who earns minimum wage earns a total of 840,000 naira per annum. And then what also has happened is that some of the deductible deductions have been streamlined. I think you have a rent allowance, you have your NHIF, NHF, you have insurance, life insurance, and health insurance, and a few other things that you can deduct. So what has happened is that they've tried to streamline the allowable deductions, and then they've tried to allow lower income earners have more take home, as it were, less tax impact. So what happens is that your first 800,000 now, you know, taxable income is taxed at 0%, which means that taxable income up to 800K is tax-free. And then the income thresholds, the bands have been extremely widened, as it were. Previously, it was at 300, 3.2 million. Now, what has happened is that from that 800, the next band is 2.2 million. After 2.2 million, the next band is 9 million, and then you have the 13, 25, and 50. Even though the some of the rates have been increased in terms of the band. So the next band, where we previously had, I think 7, 11, 19, 21, and 24, what you now have for the bands are 15, 18, 21, 23, and 25. So, if I'm asked, to answer you as someone who is seeking to collect more tax revenue, I would say that it is a band that gives us a bit of concern because, of course, it means that, we're not going to be able to target our usual suspects, which is the PAYE, the employee tax, the people in employment that is easy for us as tax practitioners. We just go, the employer should deduct and remit. So it means more work. It means that you're now going to have to target those who are earning higher incomes. And so it's really throwing it back to the tax authorities. And I think that for a government, that's commendable, because what the government is saying is that I want my tax authorities to go out there and do some work. Don't sit in your office and just wait for, PAYE to drop every month and then say you have met your target. So what the real implication is that direct assessments, persons who are not in employment, those who are self-employed, businessmen, persons who are very high income earners are really going to be the target for tax authorities going forward. So for us as tax authorities, and then speaking as the head of a tax authority at subnational level, it just means that we need to go out there and find those persons who are earning significant amounts and then ensure that they are compliant, find out all they are earning and be able to subject them to this tax table. So for the economy overall, I would say it's positive. It's positive. What then needs to happen is we need to ensure that it's properly implemented, and we need to ensure that everyone who is required to pay their taxes pays his or her fair share of taxes to government, so that, of course, we can do all of the things that government is required to do, provide education, healthcare, security, and power, etc. So that's my perspective. I really wish that Mr. Taiwo or the committee had allowed us to tax even up to 100,000 naira. But it is what it is, and we have to do the work and ensure that we're not targeting the lower income persons, but we're not targeting the higher income earners.
Yeah, thank you very much, Michael, for that balance. As the idiom will say, different strokes for different folks. All right, so I would move on to then ask Mr. Oyedele a question. So there is this question that has been, sticking out, both in questions that were sent to us, and I can even see somebody even also raised it in the comment section, and it's about the concept of effective tax rates. So, Mr. Oyedele, the bill introduces the concept of the ETR, that's the effective tax rates, where a multinational enterprise with an aggregate turnover of 20 billion and ETR less than 15% should pay additional taxes to ensure that the ETR equals 15%. So there have been questions about how would the ETR be determined? Said, should it be accounting based, or should we just solely rely on the Nigerian Revenue Service to provide further clarification through a circular on how to determine the ETR? Some fears that have been expressed in this regard is that, that power is quite wide and, would I say absolute to give to the Nigerian Revenue Service. So what are your thoughts on this, and would you like to address this?
Thank you, Patience. So that's an important question, but what you would observe on this panel already is the natural expectation when you do reforms. So you see, my brother, Mr. Ogaga, was balanced in his presentation, but then he expressed the fact that he will be paying more taxes and he's not really objecting, right? But then, of course, that's a very valid expectation of let's use this money for the benefit of the people. And that's because Mr. Ogaga is not a low-income earner, right? We recognize that I'm also in the same group with him. I'll be paying more taxes. Then you see Mike also being very honest. So his perspective about the tax band was different when he was a partner at Andersen than now that he has a mandate to go and collect taxes. So the reason I'm saying this is that you have to always ensure when you're doing reforms. So I'm the person, for example, along with many of my committee members, not all of them, because even Mike was also on the committee, that is dispassionate, like take out emotion, take out thought for any particular groups, just think about the country. So they're doing their work by saying, why don't you reconsider this? Why don't you reconsider that? It's for us to try and strike a balance. So for the effective tax rates and top-up tax to a minimum of 15%, we recognize that what we had in the original bill and that people saw which the National Assembly published was not detailed enough, and then gave so much power to the FRS or the NRS once the laws are enacted to prescribe and give further details. We have since taken those feedback on board, and we have recommended to the National Assembly as part of their work to modify that provision of the bill. So what we have proposed to the lawmakers are, number one, net income is defined as the accounting profit before tax as contained in your audited account, excluding frank investment income. So in other words, I'll pick your financial statement, I'll look for your PBT, and I'll use that figure. But if you had something like dividend income that you had received, on which withholding tax has been deducted, for accounting purposes, that will be part of your accounting profit. But for the purpose of this net income for ETR, it will be excluded. That's number one. Number two is, when we say tax should not be less than 50%, what taxes are we talking about? That also we have recommended to the lawmakers to include a definition for what we now call covered taxes. And the covered taxes would include your corporate income tax, CIT. It will include your PPT if you are in the oil and gas. It will include your hydrocarbon tax. It will include your development levy, which is almost like the equivalent of tertiary education tax that we pay today. And then should include also your income tax credits, such as priority sector tax credits, if you are eligible to that. And the additional thing that could be included is if you have exchange differences that you have included in the accounting profits on which tax is not payable now, and therefore you have calculated deferred tax. So your deferred tax on those differences will be recognized as if you pay the tax, but at 15%. So you will see that by taking all of this together, that system is fair as much as possible. If you take all of that together and your tax is still below 15%, there's something else you're doing that we don't understand. But please go and pay government at least 15%. This is also partly to address the base erosion where multinationals may not pay the expected or the appropriate or the fair amount of taxes in a particular jurisdiction, Nigeria in this case, and then that money goes to their home country, most likely a developed nation, and then they pay the tax over there. That would be Nigeria, a developing country, subsidizing another country, say the US or a country in the EU, that is a developed country. Nobody is going to continue to fold their arms and allow that to happen. And as we speak today, we have well over 70 countries that either have enacted laws or are enacting laws to do the same thing that Nigeria is trying to do now. Let it be that for once, Nigeria is one of the countries that are proactive, not just for the sake of being proactive, but ensuring that we do it within the context of our environment here. So that provision also has a few exceptions. For example, if you are a small business, this time around, in fact, what we had in the bill was 20 billion naira. And as we speak now, the conversation is to increase that 20 billion to 50 billion. So which means if your turnover is below that threshold, you wouldn't have to worry about this effective tax rate of 15%. If you operate in the zone, free zone area, and you're exporting your product, or you're operating within the zone without selling into the custom territory, you also don't have to worry unless you belong to a group, a multinational group, where your global turnover is at least 750 million euros, which is the global threshold. So in addition to that, what would then happen is that there will be an extensive guideline that will be issued. And our plan is that our committee would actually work on those guidelines. And then, of course, get the Nigeria Revenue Service to also work with us, work together, because it's their regulation by law. But we think that we should, support them to ensure that those regulations are balanced. So, let me stop there, but essentially that is what is being proposed regarding the ETR.
Yeah, all right. Thank you very much, Taiwo. So just as Ogaga had mentioned earlier, clarity is key. So if we have clarity on what we're supposed to do, then we'll be able to arrange our affairs accordingly. I just want to pick up on something you mentioned on free zones. You mentioned that it's exempted from this ETR arrangement. There have been questions around free zones. We've seen some commentators say that the tax bills have come to introduce new compliance obligations on free trade zone entities. I just want you to provide some clarity on that. Are there new compliance obligations, or is it just restating what has always been?
Yes, just to clarify, so for the ETR, it's not that if you are in the free trade zone, you are exempted. It is that you are exempted subject to, all right? So if you belong to a multinational where your global turnover is 750 million euros or more, you will not be exempted because we don't want to lose that revenue to another country. So you pay the ETR. Also, if you are in the free zone as an approved enterprise, but you are selling to the custom territory, right? Then you're also not exempted. You'll be treated similar to the way entities within the domestic market are also treated. And of course, if you're a Nigerian company operating in the zone, then you would also have different treatments. So it's not a blanket exemption, just to say that. Now, in terms of the reforms to the free zone regime generally, so one thing that is important is that the stakeholders that will be most impacted are understandably emotional about it. Excuse me. So, because for a very long time, they have taken a particular interpretation, which includes the fact that they believe that they are exempted from all taxes, federal, state, and local, regardless of what they do. But that's not what that law is saying. So if you operate within, so you see, it says within the zone, you are exempted from all taxes. If you export, you enjoy all the tax reliefs. But if you bring your goods and services to the custom territory, there's no provision today, either in the NEBSA Act or the Oil and Gas Free Trade Area Act. There's no provision anywhere, not even in the directive that government gave, allowing them to sell up to 100% to the custom territory. There is not a single document, legislation or subsidiary, substantive or subsidiary, that says that you can sell to the custom territory without paying tax. But these interpretations were adopted by the players without any major challenge by the government. So over time, it became the practice, it became the norm. In fact, I was told that there are some of the operators within the free zones who decided they should not be paying personal income tax on their staff salaries, and they stop paying PIT and PAYE, right? That clearly is not covered by any provisions of the law. So what did we do? We said there has to be fairness, there has to be equity, and a level playing field for all taxpayers. So if I'm operating within the custom territory, I'm paying all taxes, and then someone else is in the free zone, and they're producing the same goods and services and selling it in the custom territory, I cannot compete. I'm going to be out of business in the next few years. And if you allow the companies that are paying taxes to be out of business, this economy will collapse, because that means we are declaring the whole of Nigeria as a free zone. Where are we going to find the revenue from? So what we're simply saying is, let us implement the law. Let us provide clarification. We looked at a few other countries where they have free zones, including those that are within ECOWAS, like Benin Republic, like Ghana. And we found out that those guys not only ask you to pay tax when you sell to the custom territory, even when you operate within the zone and you do exports, your tax exemption for CIT purposes is time-bound in Ghana for only 10 years. After 10 years, well, if you like export, if you like whatever it is, you pay tax. In Benin Republic, after 15 years, you pay tax. So even the reform we are proposing, which is simply when you operate within the zone, no taxes. When you export, no taxes. But when you sell to the custom territory, you pay taxes proportionately to the percentage you have sold to the custom territory, right? You pay tax on everything you have sold to the custom territory. Even with that reform, Nigeria will still be the most competitive in terms of the free zone regime that we find across Africa and of course the rest of the world. It will be one of the most competitive. So everybody needs to take a step back and try and say, what is good for my country is what we should do. It may cause some, alignment necessary. You may find some, changes to your plan and projections, but just bear in mind that in the medium to long term, all of us will benefit if we do the right thing now. So that is the point about your question.
All right, thank you very much, Mr. Oyedele, and thank you for that clarification. So I'm sure entities in the free zones and their representatives that are on this call have gotten some clarity on what the tax bills propose with respect to free zone operations in Nigeria. Okay, so we would move on. We still have some panelists whose voices we've not heard. We'll move on to Dipo Mae. Dipo, speaking from, an oil and gas petroleum industry perspective, how do the reforms in the bills align with Nigeria's long-term fiscal strategy? Especially given the role of the petroleum industry's contribution to revenue. So over to you.
Okay, thank you. I think for the oil industry, we are, I say we, because I used to work in the oil industry as well. There's this happiness or joy that there's a focus on diversification, because there's a lot of focus on the oil industry. Every committee, every Senate hearing is about the oil industry. So there's happiness or joy that there's a focus on diversification of revenue sources. The oil industry is not going to continuously be the culprit. There's also an excitement on the fact that the reforms are looking at a friendly tax administration. You always want a tax administration you can discuss your problems with. One that is not adversarial in their relationship. And I think we also like the fact that we have a figurehead for reforms, a committee, and we've engaged the committee, the Presidential Committee on Tax Reforms. We've engaged them, we've discussed problems with them, and I think this is the first time you can objectively say you have
an objective committee that will listen to your problems and is the go between the industry and the government or the tax administration. So there's excitement about the tax reforms in the oil and gas industry. So that's it in a nutshell. Thank you.
Thank you, Dikpo. There is excitement in the oil and gas industry. We're not the only culprits. We are now so many. Okay. I think I'll just take the follow-up question to that, still related to the petroleum industry, and it's about the Nigerian Revenue Service and their, what I say, capacity to administer royalties. So part of the provisions in the tax bill is that the NRS, that's the Nigerian Revenue Service, will begin to administer royalties, and certain compliance requirements like royalty returns and annual returns. So do you think that the NRS is adequately equipped with technical expertise to administer this compliance requirement? Or do you think there should still be a collaboration with the NUPRC?
I think definitely there should be a collaboration with the NUPRC. NUPRC has done this exclusively for over 50 years, and there are nuances in the calculation of royalties, and that the NRS or FRS, as it is known today, will not be conversant with. So there should definitely be a collaboration. I think there's also an issue at the moment, royalty is paid quarterly in arrears.
Yes.
So in the practical situation, because I used to compute royalty, it's the provisions on paying monthly is difficult because at the end of the month, you don't really know for certainty what your production number is. You have, it's a good estimate, but it could be by the time you extract water or whatever is there, your production number changes. There's also allocations after production. So remember that, for instance, you are passing your crude through the pipelines, through the same pipelines, and there's going to be an allocation. So this is what you think is your production, but there are allocation for things like crude theft, leakages, and all of that. So paying on a monthly basis is a bit onerous because it changes from time to time, which is why the original provisions were to pay quarterly in arrears, so you can adjust in subsequent months and you won't have a lot of variation. So there's a bit of fear that what if the variation is significant, with the NRS thinking, who don't have the experience, thinking that you are trying to underpay your royalties. So there has to be a bit of hand-holding and maybe more discussion with the industry on whether royalties should be paid monthly or quarterly. I think quarterly would be the preference for most operators. Thank you.
All right, thank you, Dikpo. So interagency collaboration is key in ensuring effective administration. I would move on to Chinedu Izomike now. The question I want to ask is about capital gains tax. It's not just from me, it's from a host of other people who require clarity. So what exactly are the tax reform bills saying about capital gains tax, and what's the impact it's going to have on the administration of CGT going forward on businesses and individuals?
Okay, thank you very much, Patience. Firstly, is to agree with the whole panelists that the general sense in the industry for the reforms are very positive. People are quite happy, with the rate of work that has been done, especially the level of consultation that the committee did, and continuously taking on board concerns and ideas from the public. I think that was very well done. The idea of streamlining all the taxes and aligning them together in one document was also very good. The taxpayer was told me that his biggest challenge is knowing which finance act to consult or which law to go look at, because all the laws seem to be in different places. So bringing everything together in one document, I thought that was, a very positive thing. Speaking specifically to CGT, the way the law was crafted, so there is an attempt to merge or to align the highest rate of personal income tax, the rate of CIT, and the rate of CGT to eventually, all be at 25%. CGT is currently at 10%, and taking it to 25% potentially, seems to be a steep climb for many taxpayers, and that's quite some concern. Now, the bigger issue right now is that based on the interaction that has gone on, it appears that the CIT rate might not be coming down to 25%. I mean, based on the one that was the version that was passed by the House of Rep, the CIT seems to have stayed at 30%. So that means that CGT, because the rate of CGT and CIT are aligned in the tax law, so it perhaps means that CGT will actually be at 30%. Now, if you take something like, now to point out that the CGT, the portion of CGT in the Act actually exempts proceeds less than 150 million. So for most people, there won't be any CGT payable on their disposals. But if you look at like companies, especially on shares, maybe institutional investors or foreign investors or foreign potential investors coming into the country, up to 2022, before 2022, there was even no CGT on shares. It was completely exempt. And then CGT was introduced at 10%. Now to move from 10% to 30 within a 3-year period seems to be quite a climb in rates. I'm not sure whether that is what we finally have. I mean, we'll wait for the Senate and then we'll see what the final bill looks like. But that is the one major concern in terms of what the final CGT rate will be. I mean, if you're looking at companies either reorganizing and who do not meet the CGT exemption criteria, that becomes a huge risk. For portfolio investors who are already carrying the foreign exchange risk, significant foreign exchange risk, taking the CGT to 30% again becomes significant. So we'll wait and see how that pans out. But for CGT, that's the biggest concern as to what the rate will be. Now, if you take a look at other jurisdictions where CGT rates are similarly high, they actually have an inclusive law, so not all the gains are included. They first back out, like in South Africa, I think they back out 40% and then tax the remaining. So the effective rate will still come around that 15-16%, which Kenya is 15%. So I'm not sure whether there's still opportunity to relook that CGT rate, but I personally think that climb to 30% will be quite significant.
Well, thank you for that elucidation. It's I'm sure some people did not see it that way. Okay, I think I will take it back to Mr. Oyedele. We are fast running out of time with so many questions. Unfortunately, we will not be able to take all the questions, but we'll try to take, I think, this one more, and then I'll look through the live Q&A and we just answer maybe a few so that we don't overshoot the time that has been allotted for this webinar session. So this question, it's one that has also been discussed and debated in the public space, and it's for you, Mr. Oyedele. What is the rationale behind the new VAT revenue distribution formula? And how does it compare to the previous allocation model? A follow-up question is also, how can consumption and derivation be measured in order to justify who will collect what in the VAT sharing so as to maintain justice and fairness? So just give us an overview of what was in the mind of the drafters when this provision was being put together.
Okay, let me quickly just add some context to the point that Chinedu made around CGT. So yes, he's right that CGT now takes a different regime. So it's no longer a separate tax. So it takes your income tax regime attributes. But it does not mean that everybody will pay CIT rates, even if you're a company. It simply means that you pay your income tax rates. In other words, as an individual, if you're a low-income earner, and the item, because we exempted dwelling house, sale of 2 cars, high threshold for securities for stock in the capital market. And one other thing we've added is not only just the threshold, you must have made capital gains of at least 10 million. Because you can sell shares worth 300 million when you have not made any profit or very little profit, you will not be taxed. After all those exemptions have been taken out, you still have any gain that is chargeable. If you are someone who is on annual income of 2 million naira, you may find your tax rate is effectively less than 5%. That's what you pay on your CGT. If you're a company with turnover that is below 50, which the lawmakers, as they are discussing now, might even go up to 100 million, you have capital gains, you pay 0 because your CIT rate is 0%, right? So it would assume the life of your income tax regime that applies to you. And that's because we want it to be progressive. For oil and gas companies, particularly upstream, where their rate can be as high as 85%, the CGT is referenced to CIT, so which means nobody will pay more than 30% or 25% if we succeed in reducing the CIT rate. So I don't think it's something we should worry too much about. At some point, we're working on possible indexation for the entire tax regime in Nigeria, not just for CGT. Because if you say that today, first 800,000 naira is 0%, if you don't do anything in the next few years, that 800,000 naira becomes like very embarrassingly low. To the question around VAT, so I don't know whether you have the press here. I would assume that you have press. So I try not to speak to this issue around VAT distribution anymore after the engagement we have with the governors, because the press is just looking for something to sensationalize. So they will say presidential committee disagrees with the governors. Presidential committee says National Assembly should not go ahead. So I'll just take a step back and say, if anybody is really particularly interested in the basis for what we propose, what the governors came up with, and what the House of Rep has done in their own review, we're waiting for the Senate to complete their own review. We have loads of materials that they can read up. So you would excuse me on that question. Thank you.
All right, that's fine, Mr. Idile. That's quite understandable. I'll take one question from the comments section, and it simply says, would we still have certificate of acceptances of fixed assets going forward?
Our plan is not to have a certificate of capital acceptance. We also don't want tax clearance certificates. I know Mike Ango is not happy with it. For CAFA, the compromise we have reached is that we will not have CAFA for assets, capital allowance purposes, but you would need it for if you want priority sector incentive. So you want to do something, you want to get incentive, we say invest at least 10 billion naira, then that department, industrial department, would validate and do evaluation of your minimum investments. But you will need CAFA for capital allowance purposes as a matter of routine. So that is the position as we speak. Of course, the big caveat is that anything to do with the bills from this point forward, it is with the lawmakers and not within our powers. We're only just providing clarification to them and making recommendations which they may or may not accept. But as of today, CAFA is being looked at in the way I just described. The same thing for TCC, tax clearance certificates. It will not be applicable anymore for companies, but for individuals, the JTB members were very, very strongly opposed to removing it completely. So we also reached a compromise of limited transactions where you need tax clearance certificates. And that proposal we've now shared with the lawmakers for their consideration. Whether they will adopt it, we don't know. Whether they will not adopt it, we don't know. But what we know is that tax clearance certificate in its current form under extant laws will no longer be the case under the reforms. Under the reforms, you either not have TCC at all, or you have TCC applicable to individuals under very limited circumstances.
All right, thank you very much. I'm looking at my time, I think we still have like 4 minutes for questions, just 4 minutes. There are a lot of questions pouring in, and I'm trying to accommodate it as much as I can. But there's this other question about the VAT modification order. Now, this is not about VAT distribution formula, so I believe we shouldn't have concerns about the press. So the person says section 199(1) revokes the VAT modification order. One implication of this is that gas supplied to the GENCOs will now be subject to VAT, and such costs will pass to the final consumer, hence increasing the cost of power. Says, is this the intention of the drafters?
What I can tell you is that we have the savings provisions under section 200 of the NTB, where orders and directives are supposed to continue under the reforms, except if they are specifically inconsistent with the provisions of the reforms. When it comes to feed gas, the bills, the provision of the bills make them exempt. But even if you are doing, gas, you're doing power, and you take the view that you have to pay VAT on feed gas, what we've done is to zero rate the activities within the electricity sector, apart from the final retail side, are zero rate. If it's zero rated, it means that even if you have to pay, you claim it back 100%. And if it's exempt, then it means you don't have to pay. So either way you look at it, this will not result in higher costs of operation for the energy providers, such that you have to then pass it on to their customers. So I would encourage that you have a look at that and see whether it addresses the concern that you raised. If not, then you let us know if there's anything we can still do at this stage. But I can tell you it's one area where we spent a lot of time, including with players in the gas sector and the other people within the value chain, including even somebody passing gas through their pipe, right? They just have the gas infrastructure and they collect and then they pass it through. Should they have to pay? Should they be exempt? Are they zero rated? So we have tried as much as possible not to make the current situation worse than it is under the reforms. And there's also a provision in one of the schedules where the minister is given the powers when it has to do with things like energy products, like clean energy, like aviation, and a few other things where the minister can change the status of the item between zero exempt and standard rated, including suspending the application of VAT or ordering that the application of VAT should commence. So we believe that gives the executive the powers to try and moderate things based on the economic circumstances of the country. We know there are lawyers who take the view that those powers cannot be delegated by the National Assembly to the executive, but we'd rather have that debate than not having that option available in the law. At the end of the day, if government issues an order to say that gas or feed gas or PMS or AGO is not liable to VAT, I actually don't see someone going to court to fight the government. So which means practically it helps you to solve the problem per time.
Yeah, thank you very much for that comment, Mr. Oyedele. So for the person who asked that question specifically, you can always reach out to the Fiscal Reforms Committee if you have other clarifications you require or you have other suggestions or complaints. Yes. All right. So thank you very much to all our panelists. Our time is far spent. I think at this point, we'll just take maybe 30 seconds closing remarks from the panelists, and then I would invite our partner, Yemi Adediran, to give the vote of thanks. So I think, Mr. Oyedele, you can go first, your closing remarks.
Yeah, thank you. I think my closing remarks is just to thank everyone and then to encourage us to do a little bit more. I would tell you authoritatively that all of us are going back to school. It's almost like a completely new tax system. By the time you start focusing on the details, you see the level of transformation in those reforms. And if we don't get up to speed on time, we will lose out on the benefits, and we may just unnecessarily expose ourselves to risk of compliance. So the time to start building capacity, paying attention, getting ready was yesterday. The next best time is today. We are doing it ourselves. I'm doing it myself. We're doing it with our committee. We're working on a plan for capacity development, sensitization, and awareness for stakeholders. But the more people that come on board to provide support, the merrier and the better for the country. So thank you once again.
All right, thank you very much, Mr. Ango. Okay, if Mr. Ango is unable to speak now, I think
Apologies, Patience. I think my network was freezing. Can you repeat what you said, please?
yes, we're just taking 30 seconds closing remarks.
All right. Okay. Let me just say that first and foremost, and I'm not trying to patronize Mr. Oyedele. We've had several interactions. Of course, I was a member of the committee, so I was part of some of the processes. There's a lot that has happened. There's no legislation on earth that is perfect. There would always be interests, whether group interests, some even personal. But I think that these particular reforms have been largely, objective. And I think that however what we get, let us take it and then run with it. We would always have the chance to do a review. And I think what these reforms have also shown us is that as a country, we cannot neglect our tax legislation and our tax systems for too long. If possible, let us even be looking at these things annually or as often as possible so that we don't get a legislation like the Stamp Duties Act that stays for 60 years or 70 years without being reviewed. So for me, I'm totally in support of it. There was a particular issue we had with Mr. Oyedele, not with Mr. Oyedele, of course, but with one of the bills, and we had to come as a committee of tax authorities and plead and appeal and cajole, because we thought that it was important that that particular thing be retained in the law. But at the end of the day, honestly speaking, however the law comes out, it is important and incumbent upon us to support it, to then, of course, ensure that we are, very aware of what the law says, and then to drive compliance by everyone. If there are issues, if there are challenges, let us highlight them, let us document them. I believe this government is a listening one, even if I say so. And I believe that at the end of the day, there's something for everyone in these tax reform bills. And at the end of the day, I think it's going to be to the benefit of the Nigerian economy. So thank you for inviting me, Andersen. I appreciate the opportunity. In fact, this particular webinar made me to go back and study some of the provisions of the bills, which I hadn't been aware of. So I think there should also be, maybe when the bills are passed, you may want to do a much more detailed interaction or stakeholder engagement or, forum where we can discuss some of these things in more detail, because this is one of the most, if not the most significant reforms of tax legislation we've had in Nigerian history. And I think there's need to ensure that everybody is aware of what is done and what his or her obligations, rights, and duties will be under this new tax legislation. So thank you.
All right, thank you, Mr. Ango. Chinedu, would you like to go next?
Okay, thanks so much, Patience, and thanks, Mr. Taiwo, for honoring us with your presence. I think it's important that everyone appreciates the enormous effort that it took to get the bill to where it is currently. I'm reviewing the entire tax laws in Nigeria, bringing them together, harmonizing them, and then navigating the landmines of geopolitics and all that it's a tremendous amount of work, and we really appreciate Taiwo for that effort and continuing, being a calm voice leading the country through that reforms. So the taxpayers, I want to say that this bill is happening. The act is coming. There are still people thinking that maybe will it pass, will it not pass? It's going to come, and most likely from the second part of the year, by second half of the year, inflation might start. So it's important that we all engage with the bill, stay informed, do an impact assessment internally. There are transactions that you might have to revisit. There are business structures you might have to review. You have to fully understand how it impacts your business, because each business is different. Depending on your industry, depending on your transactions, it might be different how it impacts you. And plan to be compliant, and of course, seek professional advice as may be necessary. Thank you very much.
Thank you very much, Chinedu. Dikpo, can we have you?
Okay, thank you. Just to say thank you to Taiwo for honoring us with his presence, and the committee for always being engaging. We see the reasons for the reforms and the work that went into the reforms. We want to appeal to the committee that a lot of these reforms affect the taxpayers. We're hoping that at some point there will be reforms that really impact government, particularly in the area of borrowing. We have, to a large extent uncurtailed borrowing and a lack of judicious use of resources. So there's a lot of focus on the taxpayer. We know it's a fiscal committee, so we want, when the bills are passed into law, there should be a bit of focus on government as well, because people are willing to pay if they feel government is responsible and makes judicious use of the resources. So thank you very much, Taiwo. Thank you, committee. And thank you, everyone, for the beautiful questions you asked. Thank you.
All right, thank you. Thank you very much to everyone. Thank you to our panelists. This has been a very interactive and enlightening session. Over the course of the session, we had about 400 participants join us. We apologize if we could not take your questions. We are very constrained by the time limits. So thank you again for honoring our invite. We trust you have learned a great deal. At this point, I would like to invite Yemi Adediran, a partner in the Commercial Practice Group, to give the closing remarks for this session. Yemi, over to you.
Yeah, thanks, Patience, and special thanks to Taiwo for making our time to join us this morning. I think one of the most important things that you said is that we're not just looking at the tax side of things, we're also looking at how the tax is going to be spent, how we spend our money as a nation, the quality of spending, and how do we borrow when what we have earned is not enough, and the consequences of breaching policies that have been set in place. Because, policies create expectations from the people, and when they are breached, there should be consequences. I also want to thank the panelists from Dikpo to Chinedu, Michael and Ogaga, for making our time to discuss with us and to share their thoughts on the tax bills. And special thanks to you as well, Patience, for coordinating this webinar and for the insightful comments and thoughts throughout the session. And finally, I would thank the panelists for staying with us all through the conversations. There's still more to be said, but unfortunately, we have run out of time. We'll continue to engage the authorities, the committee, and also bring you updates as the reforms take shape from the Senate to the presidency. And finally, we have a new tax regime in our hands. Thank you, everyone, and have a beautiful day.
So thank you, everyone. So we'll see you next time. Bye-bye.